tonight we're going to talk about one of the most interesting topics, I think, which is how do you actually do money management, wealth management, and investing as an entrepreneur when the vast majority of your wealth is going to be inside the equity of your business or businesses, and when those are always going to be your best returning asset class. So how do we actually go through and invest anything that we want to invest outside the business while still getting to all of our personal and family goals, and while not hindering the growth of the business that we are all working so hard for? So when we look at that, it's really a process of matching up all of your known and anticipated needs and goals with your capital stack and then segmenting it out based on time. What ends up destroying a lot of wealth in the investing process is having to liquidate assets, particularly growth assets like stocks, equities, real estate, anything that's harder to sell and less liquid, when you have to liquidate those on a timeline that you don't want to, which is usually when the price is down. So when we're looking at that, we always want to look at three different tranches. So tranche number one is what we call the short-term investing bucket. Now, this can be 1 to 2 years. I think for the purpose of this brief video, think of it as anything that you know you're going to need inside the next year, or that you want to have in reserve just in case inside the next 12 months. This is going to be sitting in cash, in perhaps premium money market, maybe in individual bonds or certificates of deposit, which will mature within that 1 year time frame. Think of it as cash. This is really money that's designed to be there and back up everything that you're doing personally and in the business. If you have an income disruption, that's where the money needs to go. If you have an opportunity in the business and want to inject some back in, that's where this money needs to go. You're really not trying to generate a whole lot of rate of return. And this is also where your holding money for quarterly estimated tax payments should go. Second tranche is in your midterm bucket. This is anything that you're going to spend in between 1 and 3 years or think that you might spend. So if you have a big initiative, if you want to be buying a second home, if you think you might want to do something big to an existing home, we see these all the time, home renovation projects that run into the high figure numbers, whatever it is, that's where this money should be. Now you can start doing a little bit more growth investing here, but not a ton. Most of this is going to be in fixed income, perhaps a little bit in cash. Again, think about you're generating single-digit rates of return on this. It's relatively stable because 2 to 3 years is not a long time, and you don't want assets that are going to be highly volatile or difficult to sell in that time period. And then finally, we're into the long-term bucket. Now, we recommend including your business equity in your investing strategy, so that should always go in the long-term bucket unless you're on a sale path with a pretty predictable timeline around it. So this is going to be your stock investing, perhaps venture capital, private equity, direct real estate investing, anything that is going to be sold 3 years or longer into the future. That's enough time for price volatility to kind of wash itself out and get to a point where you're going to feel okay selling when you do need to sell something. So when you think about investing as an entrepreneur, anything that isn't directly your business equity or capital inside your business should really be laid out in that time segmentation strategy. Head over to entrepreneuraligned.com. We've got a deeper breakdown there and a case study that you can look at to really understand the concept. Hope this was useful. We'll be back soon.